Hi guys, welcome to our webinar today. We're going to give everybody a log in. I think 11:30 Central was our start time, and so we're a couple minutes early on. If you would like, if you haven't used this software before, or if you have, on the bottom of your screen, hopefully there's a couple options for you to utilize. One of those will be a call to actions, ask questions, things like that, polls. So we'll be able to interact with you guys. Hey Ernest, good to see you. So if you want to say hello, just to make sure your device is working, feel free to do that. You can interact with questions or whatever it may be. If we have any questions that are pertinent to the topic as we go, we can certainly address those on time, or if we need to follow up on anything at the end so that it doesn't waste the attendee's time. If it's off topic, we can do that as well. I think we've got about an hour scheduled today for our time, but I really don't think we're going to need that much of your time because we can always follow up afterwards with anything you may need and take care of it at that point. So we are on time. I'll let it go to at least 11:31. I think everybody deserves our punctuality today. So appreciate you guys joining with us. And if you have any questions, again, on the right side, feel free to let us know what those are. Or just say hello, or if nothing else, tell us where you're from today. So it's always interesting to see where everybody's tuning in from. Welcome to our webinar. Today we're going to be talking about lending and how that affects investors and different options for investors, good and bad things that we've experienced over the years. And we're just going to kind of go back and forth. So my name is Matt Leschper. I am the owner of 1836 Realty and Property Management. I've been in real estate about 12 plus years at this point. And so I started out in sales, did a couple years there, and found out that while it's good to be in sales, I really enjoyed the management aspect of things. Being able to have employees that you collaborate with, build systems, build a business is something that I've really enjoyed over the years. My employees are like family to me, and I say that every day to them. So it's to me, it's a little bit better experience on that end. I am licensed as a real estate broker, a licensed professional real estate inspector. And at one time I thought I wanted to get into lending until I found out how difficult it was. And then I let that idea go quickly, and I rely on some experts, which we've got with us today. So Candy Buzan is with us today. She is a longtime friend of mine, highly respected, and just a wonderful person in general. She's also very skilled, and I can say that on a personal basis, she's the first person I call when I want to do anything for personal loans. So Candy, provided that we get all this technology to work today, do you mind taking a couple minutes to introduce yourself and just say hello to everybody?
Sure. Good morning, everyone. I'm Candy Buzan with New American Funding. I've been in the mortgage business for 34 years. I have a team of 11 people that we work together to provide the highest level of service to our customers. We've all been together from 25 years on. I don't think I have anyone on my team that's been with me less than 10 years. So there's 11 of us, and we like to take good care of our customers. So New American Funding is a company based out of California. We retain all our own servicing. So all loans are serviced right here in Austin for the full United States. So it's really a great company. We retain servicing. You'll make your mortgage payments here with us. So we're really proud to be part of their team.
So when you say you're retaining servicing, that means that their loan's not going to be sent off to somebody who's going to lose it to somebody else who's going to then send them a bill 3 months later for something they didn't pay?
Correct. Absolutely. So we retain over 100 employees here in Austin to service the loans. For most of you who may or may not know, there's two components to a loan. There's the whole loan that's typically sold either to Fannie Mae or Freddie Mac within the loan limits that they purchase loans in. And then there's the servicing element. So we actually sell the loans to Fannie or Freddie, but we retain the servicing rights. That means that buyers make their payments to us. Not only do they make their payments to us, but they can also drop their mortgage insurance when Fannie and Freddie allow them to drop mortgage insurance. They can do recasts of their existing mortgages here. Also, any countersigning checks for servicing of loans. For example, if you had flood damage, hail damage, the servicing and countersigning of those checks are done here locally as well. So,
a lot of this we hadn't talked about, except some high points that we wanted to hit. But as we have this conversation, there's some interesting topics that are going to come out of it. One of those being What a concept that you would actually service the loan in the city where most of these people are investing their money. I'm
Yes,
not saying it can't be done worldwide or with technology now, but when problems happen and you want to know where to find somebody, man, is it comforting to be able to go, I can see those people. I can actually go
that's
over
right.
there and deal with them or take care of business, whatever that may be. Or just simply knowing you're in the same community kind of connects you as humans. And
Right.
I don't know of anybody else that's doing that here. And I haven't heard of anybody servicing loans here.
No, not here in Austin. Certainly not. And New American, I think he's the only one probably here doing that. And like I said, they service loans here for the whole United States. So we're quite fortunate to be part of their team here locally. Um, it's such a huge element. You don't know you need this service until you need it. When you have a roof damage and your mortgage company has to countersign the insurance claim check for you to be able to deposit it, to know you can have that check signed right here on Lakeline Boulevard and Lake Creek Parkway is quite convenient for people.
That's really cool. Not something I had even thought about, but I've definitely experienced the problems that I'm sure a lot of investors have is when they close the loan, they have no idea where it's going or who to
Sure.
contact or where to get them. And it's kind of scary to feel like these people are in a cubicle somewhere that don't care when, if
Right.
they're down the street in Austin, they're at least real people here in town. So that's kind of nice.
Yeah, it is. It's great. We're happy to be here.
That's comforting. Well, we've got a couple topics we're going to cover today. Um, Four main ones, and then we'll get to some fun at the end of this. The first one we're looking at, and all these should be interesting to investors. That's our goal today, and lending being the topic. Let's talk about what happens when you get a new loan regarding cash reserves and qualifying, and then we can get into how those are specific for Freddie and Fannie and for properties and things like that we've kind of touched on in the past. And I'm going to let you really get into that so that I don't mess it up
Sure.
for you.
Sure, no problem. So cash reserves becomes a big issue for investors. Um, Not only do they have to have their down payment, but they have to have what's called cash reserves. Cash reserves is money left over after you make your down payment and pay your closing costs that can be used in the event of an emergency. So that's why it's called reserves. So what we're typically going to need if you have 6 or less properties financed, you're going to need 2 house payments in the bank for every property financed. Okay. If you have more than 6 properties financed, then it becomes a calculation of your a percentage of your unpaid principal balances. The more units you have, the more cash reserves you have to have. So for simplicity purposes, the first 6 units, you really need 2 months reserves for every property financed. So that's where the majority of people are going to be, is the 1 to 6. But we do allow financing up to 10 properties financed. So Fannie Mae will finance 10 properties financed. That's not units, it's mortgages. So if you have a fourplex, that's 1 property financed. So the reserves becomes a big issue. Another thing with that is you can't use what's called gift money. So someone can't give you the money, even if it's your wife. If it comes out of her account that it doesn't have both names on it, that's construed to be a gift. So all funds have to be our borrower's money for closing and reserves. However, one thing to keep in mind is that we can use IRAs and 401ks as cash reserves. So that is beneficial to people.
So, boy, I've got a lot of questions out of this, and we'll make sure we stay on time here for everybody. But so back to the 1 to 6. So as we've kind of studied on our end of things, we have a lot of investors, and they kind of go, "Well, I've only got 1 or 2 properties. I've only got 3 properties." And statistically, what's kind of interesting is the vast majority of investors, something like 92% in the United States, have 3 or less properties. So we all feel like we're competing against these wealthy families. The truth is, we're all just trying to survive and get along and do the best we can do for our families. And everybody should realize that when you say 1 to 6, that is the vast majority. I mean, there's only a 1 or 2% that really have more than 6 properties across the
Right.
entire U.S. Now, we're not talking about institutional investors. We're talking
Right.
about individuals, families, things like that. So
That's right.
that covers the vast majority of everybody we're going to interact with. When you're saying up to 10, because we all do want to know what happens when we finally get rich and we paid them all off and we've got 10. What happens for folks, just for the sake of the argument, when they get to 10 units? What do they do?
Well, they're typically going to have to go to a bank that's not selling to Fannie Mae,
Mhm.
that portfolios their own loans. So what you're looking at there is probably a higher rate and shorter term, because you're not going to get a 30-year fixed rate at a commercial bank. That's not their book of business.
No.
But that's where you have to go from there. Fannie Mae used to finance up to 20 properties. In the 90s, they were doing up to 20 properties financed. This 10 property limitation has been probably in the last 10 years that they dropped it down to 10 properties financed. But for now, it's 10. 6 months from now, it might go to 20, but right now it is 10.
Who knows with politics?
Who knows? The mortgage business, I can tell you the guidelines today. I'm not sure what they'll be tomorrow.
Right.
But I think we're going to see the mortgage environment loosen up. So we're going to be doing more lending in areas we have not been doing in the last 10 years since the housing crisis. So little by little, they are loosening up the rules.
So what's interesting as a takeaway kind of from what you mentioned is when you get to 10 properties, you're saying that you're going to go to a bank or an institution or some sort of lender. What that tells me is no different than if you went to the bank and said, I want to borrow money from you for something else. They're going to say, it's a business. Let's talk about this like a business, not can I buy a house because I want to invest, and let's look at the numbers and, oh goodness, I can resell this. So I'm not trying to say it's required by any means, but no different than in our business, I want to be able to certify the books so that if anybody has questions, I can deal with those problems. And so that if I ever wanted to sell in the future, it's locked in. I can't help but think that if you go and you have a management company or you have your income and expenses dialed into a T, and they can have somebody else to refer to say this is an independent person who knows what they're doing, that's not going to benefit you when you get in front of that banking person, because they're a business person. They're not a lender to put your house in. It's going to be a whole different conversation.
Sure, absolutely. And different guidelines, different rules,
anything they want, it's their money.
Yeah, whatever guidelines they want to make up, they can certainly do. I would think regulatory wise, you're probably not going to see less than 20% down, just because regulators, you're not going to see that. If you want to do less than 20%, that's going to be on the first, properties we do, the first 6 that we do. You can do 15% down and pay mortgage insurance.
Don't spoil it. We're going to get to that one.
Oh, okay.
So, but yeah, when you're talking about no gift money and then IRAs, you said you can use IRAs, but we've already heard a lot about self-directed IRAs, and I'm not a financial guy when it comes to advising people, but self-directed versus regular IRAs and that. Is there a specificity of what you need or don't need when you're talking about IRAs?
No, not necessarily, because we can use even 401ks, because what we're talking about using that for is cash reserves.
Okay.
Now you can borrow against a 401k for your down payment, so that would be perfectly acceptable. But a lot of times we see them primarily used as cash reserves. A lot of borrowers, they're trying to diversify their retirement futures. So they want to keep their 401 and have rental property for some diversification. So typically they're not wanting to borrow against it, but they can. But I think cash reserves is a good resource for 401s.
Yeah, how nice that you can actually invest in this and then use that just as that verification of reserves.
Sure, absolutely.
That's brilliant to have. All right, so next topic, which is what you alluded to, was most of us as investors, we go in and we're expecting to put 20% down. That's just kind of become a norm. Some even a little higher. We're not going to talk about those bankers that you and I know that are really tight and want a lot more down. But you're saying you can do loans with 15% down now, which would enable, in theory, you to buy more properties with a given set of capital.
Sure, absolutely. You'll be able to leverage more with 15% down. You can only do 15% down on single family residences. So you can't buy a duplex, 3-plex, or 4-plex with 15% down. We're talking about single family residences. So 15% down, you are going to have mortgage insurance. The mortgage insurance is going to run 0.53 annually, prorated monthly if your credit scores are 760 or greater. So if you think of it in this respect, if you're financing $100,000, that's $530 divided by 12. So that would be your mortgage insurance.
Okay.
For a 15% down investment property loan.
Now, you had mentioned something about the mortgage insurance on this, or I may have heard you incorrectly. Something about it doesn't fall off on this, where it would on others.
It does. It's just the guidelines are much more strict.
Okay.
So if you do 15% down and your loan is a Fannie Mae loan, then your mortgage insurance can be dropped when you're at a 70% loan to value, along with other rules like paying it on time and, escrow account not be, all these other rules associated with it. But generally speaking, what people want to know is you have to be at a 70% loan to value to drop your mortgage insurance on a Fannie Mae loan and 65% on a Freddie Mac loan.
Okay.
They're going to have pretty good equity positions to drop in my own investment.
It does come off. It just takes a minute.
It just takes a while.
Right.
Yeah, absolutely.
Okay. So, and you were saying up to 6 of those. Is that correct?
Right. That's correct. Fannie does the first 4 and then the next 2. So Fannie Mae has two sets of guidelines, 1 to 4 family and then 5 to 10 properties finance. So 1 to 4 finance, 5 to 10 finance. Freddie Mac has one guideline. They'll do up to 6 properties finance. So that's why we say it kind of depends on whether you're between 4 and 6 on which way we go.
Well, and which way the legislation blows on the, next
Right.
Folks in office.
Absolutely.
So why do you think why 6 is just the magic number that they've determined as risk tolerance and everything else? There's no magic.
Yeah, and I think they're trying to have a little bit of a niche that Fannie doesn't have. So they have a few things that are different. Most of their guidelines mirror each other, but they do have some things that are a little bit different. And I think sometimes they're just trying to capture a little piece of the market that Fannie hadn't gotten. So I think it's strategic.
That's funny. Why single family, but they're excluding the others? Is that because that's their purpose in life, or is that something else?
No, I think single family seem to be the lowest risk. When you get to multifamily properties, if you have a downturn in the market, multifamily are in their opinion, the first properties that decline in value, that go into foreclosure. It's going to be the multifamily over the single family.
Boy, I want to take that out of the recording and snip at that, because that is supporting exactly what we believe in, and we've been telling everybody is our bread and butter. People go to seminars and they think, oh, I've heard this guy talk, and all I need to do is buy this 12-plex, and life is going to be good because there's only one roof on it, and life is going to be easy. And the truth is those people start fighting with each other because they live next door to each other. Then you've got common parking lots where you're spending money on a porter to pick up garbage that nobody claims. Single family, we don't have any of that. There's one family there. If something goes wrong, you know who did it, or they know who did it either way.
Right, absolutely.
Families are just, I hate to say no brainers, but if you just buy them right, you don't overpay, you do your diligence, they're kind of hard to mess up.
Yeah, I agree 100%. And if you do have a downturn in the market, they're the easiest to rent. In my personal experience.
I completely agree. And the beauty is that you can fluctuate the price on it and get that thing rented almost immediately, because no matter what we do or don't like, we've got to live somewhere.
Right. Absolutely.
There's always a need for housing of that nature.
Right.
But I've got to find a way to cut that out, because that's just gold right there for everybody. Right. Everybody wonders, and they hear seminars and they read books about getting rich. And the truth is that it's simple. Simple is pretty. So I really appreciate you sharing that with everybody.
Yeah. And it's the tortoise and the hare theory, right?
It is, but how hard is it?
It's not a get rich quick deal.
No, but
that's right.
Austin has been doing so well, and as you've seen in the area, that we have clients that come to us every year almost and go, wow, my house went up in value, all this money, I'm ready to sell. And we go, why?
And where are you going?
Well, what are you going to do with the money? And beyond that, where are you going to make that kind of rate of return? And if you're buying a Range Rover, that's a problem, because this is really investment for retirement. This isn't about getting money to spend somewhere else. So I had someone poke me and say they may have lost a part of the video. So I'm going to ask our participants just to give us a clue and let us know if the video is still working for them, or if it was just one person that lost that. So if you guys, we're going to keep going, but plug back in if you would, just respond, let us know. Kathy said it works fine. So thank you, Kathy. Much appreciated just for that confirmation.
Can I add one thing to what you just said? I think it's very important.
Kathy, can you see Candy as well, or just myself? She says yes. So, okay. Well, I think maybe just one user out there. So Really appreciate that. Love it. Thank you guys. Thanks, Seth, for the help. It's always the technology is what it is, so we do our best with it. But thank you very much for helping us help you. So you had one more thing, Candy? I didn't mean to interrupt you.
Yeah, I just wanted to add one thing that the beauty of rent property, in my perspective, is the only way we can retire is we have to have passive income. And rent property is the perfect passive income vehicle. I think that's why investment properties are so great for people, especially, if you just need one or two to supplement your other income in your retirement. If you have two good properties, you've been able to pay them off and get them paid off, that passive income, you just can't beat it. And it stays up with inflation because your property values are going to continue to climb.
Absolutely. And the mortgage is fixed. So even as you pay down
Right.
the note, inflation happens, appreciation happens, you're still paying the same. These clients that come to us, really 3 to 4 years is that crossover, even if they're what we call reluctant landlords. I wanted to sell, I can't afford to sell, I haven't had it long enough, so doggone it, I'm going to rent this thing. 3 to 4 years, they cross over to this point of, okay, wow, it's on autopilot and it's just working now. And
It pays for itself.
it does. But they're nervous
Yeah.
the first few years always, well, and we respect that. But really
Absolutely.
seeing down the road and knowing that it happens, we have a handful of clients, I can think of two off the top of my head, who's both of them, their grandmother purchased property and multiple properties. And the granddaughters now, it was the mothers and the daughters, are both sitting back going, my grandmother just said, don't ever sell real estate. And they're sitting back with passive income every month, both of them for 5 or more properties. And they have really good lives. And it wasn't real complex. It just took patience. It takes time. Time is our enemy, not money. We can get all the money we want if we get all the time we want. But that time is being the question. So we're getting off a little bit. My apologies. Rehab loans. Everybody wants to come in, they're going to find this house. It's going to be, man, it's really ugly, but we can just get this rehab loan because I read about it, and I'll roll in all the money and I'll get it all fixed up, and then it'll just, that's what we're going to do because I read it in a book or I've read it on the government. Talk to me about rehab loans. What's your experience with those?
We do quite a bit of renovation loans. Fannie Mae has a program called Home Style Renovation. FHA has the FHA 203K. The FHA loan is for owner occupants only. The Fannie Mae versions we can do for any loan type. But what people have to understand when they're doing renovation loans is it's two loan approvals at once. You have a normal credit file, just like you're purchasing a property, but you also have the construction element that you have to have approved. So the contractor has to be approved with us. We have to have proof of liability, all the contractors, if there's permitting required. We require all the licenses of anyone who's required to be licensed in the state of Texas. So essentially what happens is, say you buy a property worth $100,000 and you need $25,000 worth of renovation. Then you have to get a bid from a contractor for us to even order an appraisal, because the appraised value comes in at two values, an as-is value and an as-repaired value. So these things take some time. The problem we have found in this market with doing renovation loans is sellers aren't real amenable to 45-day closings or 60-day closings or whatever it's going to take to do the renovation piece. So what we see a lot of times is people getting beat out by cash borrowers on properties that need renovations. People who need financing don't always get the contracts on those properties because they are a little bit more complicated. They take longer to close because you have a construction piece associated with it. Like I said, you can't even order an appraisal till you have a bid.
Last one that I was privy to, and please tell me this was an anomaly, wasn't normal, but not only did we have to get the construction piece involved, but you really need a general contractor because it's a full-time job getting all the various trades lined up in the right order with the permits. And some of these vendors had to actually sign off at closing.
Yeah, they all have to.
They all have to show up. So you may have 10 different vendors signing documents on your note at closing, and they don't get paid until later. So you have to find people who are willing to float your bill as a vendor you've never met, get someone to orchestrate that like a general contractor.
Right.
I don't know an electrician that's going to show up and sign paperwork at closing for somebody they don't know. It's just scary.
Well, that's why you need a general contractor,
You
right?
have
You're
to.
going to have a general, and you can't be your own because we're not going to allow you to be your own general contractor.
What a concept.
Yeah, I know.
So it's just
We kind
not.
of want somebody to know what they're doing.
Yeah, and it's just not as simple as the textbooks make it sound. People charge
No,
for seminars and everything else, and oh, you just do this and this, and it'll be fine. And the truth is that if it was that easy, everybody'd be doing it. It's
right.
more complex, and while it is possible, it's not easy. And you and I want to see our clients smiling. We don't
Sure.
want to see them get into something that they're going to be having a really difficult time with once they get into it.
Right.
So it's possible. Have you seen a lot of these favorably end? You do a lot of volume.
Well, I mean, a lot of them, I mean, they end fine, but people have to have a lot of patience because when you're dealing with renovation, there's a lot of unknowns. I mean, we require contingency reserve of 10%. If there's structural issues, we require a 20% contingency reserve built into it. But there's so many unknowns when you're dealing with renovation that people really have to have a lot of patience. And it's just they're difficult to do, but we do them. But to be very honest with you, we talk about them more than we do them because for one reason or another, people are just like, I can't even get the offer accepted if I'm doing a loan.
That's exactly where I was going to go back, especially in the Austin economy. You're looking at at least 2 or 3 players on each one if you're lucky.
Right.
And if you're looking at somebody who doesn't have the money to maintain their property in the first place, maybe it's an estate sale and the kids are all fighting or whatever it may be, they want cash in to go. They're not going to wait around 60 days to see if the loan maybe closes, even if it's $5,000 difference. I'll take the one in the hand versus 2 in the bush all day long.
Absolutely. That's what we find out too, because we talk about them a lot, but we just don't do many of them for that reason. Now, when the economy wasn't booming back in Austin, we did more renovation loans because sellers would be cooperative because they needed to sell their property.
They had to.
That's just not the situation we're in any longer.
Agreed. Yeah, and I'm looking at the cranes outside my window. I don't see it slowing down anytime soon.
It doesn't appear to be, no.
No. So last one of the major topics we're going to cover today, and I think we're doing brilliant on time, is qualifying for a loan, but involving market rent. So what does that even mean? Okay.
So when someone purchases an investment property, we're allowed to use the fair market rent of the property to offset the mortgage that you're obtaining to purchase that property. So what happens is when we order an appraisal, the appraiser provides sale comps for comparable sales, but they also, just like they normally would, but they also add rent comparables. So the appraiser adds the rent comps, and then we use those rent comps from the appraisal to offset the payment. So there's a worksheet attached to the appraisal that we calculate the formula. But generally, if you're doing 20% down, you're probably cash flowing enough to make the payment. If you're doing 15% down, you may have some negative cash flow associated because they do count about a 25% vacancy and maintenance allowance, assuming you're going to be vacant some and you're going to have some maintenance. So if you do 15% down, you may have some negative cash flow that we're having to calculate in your qualifying ratios. But most of the time, the property will pay for itself according to the worksheet. And so you're not really qualifying for the new mortgage. You're just qualifying for your current debt. Typically.
So one of the things you mentioned there, which I think it's important for us to point out just to be definitive about, is that a lot of folks have a concept that they can get into these loans and when the appraisal's done, if they don't agree with it or something, that they're going to be able to just change it. Or, when you're saying a worksheet with rental comps as well, they're going to be able to argue those points. And while there is a kind of way to get to people and manipulate it a little bit, the truth is that these appraisers, and again, correct me always if I'm wrong, are hired, a lot of them through a round robin system, third-party companies, and it comes back around, and they're completely independent for a reason. And you should not be able to influence an appraiser unless they made a true error. And so you may have I don't mean to throw people under the bus, but there's a lot of realtors out there that'll tell you anything you want to hear simply because they want to see you happy. And the truth is, numbers are numbers, stats are stats.
Right.
There's no opinion when it comes to math. It is what it is. And you could have an agent come to you and say, well, you're going to get $5,000 a month for this property. And the truth is you're not. And so you really need, regardless of who your agent is, irrelevant, you need somebody who's radically candid with you and shares the numbers with you so that you don't go through these entire processes and find out that you missed it by a $200 rental because they were being rosy trying to get you to close on this house.
Right. Exactly.
Yeah.
Exactly. The appraisal process is regulated now. The Consumer Finance Protection Bureau, as part of their regulating of lenders, came out and said that lenders weren't allowed to order appraisals without ordering them on a rotating basis, because they didn't want lenders influencing the value of the properties. So what happens is lenders have to have a panel of appraisers. For example, I have a panel of appraisers. I can choose my panel, but I can't choose my appraiser. So they come off of a rotating list. So some companies use third-party vendors where they don't pick the panel of appraisers. They just let the vendor pick them. That's a little bit different. Each lender's a little bit different on how they run the appraisal piece. But long story short is it's a third-party opinion. We have very little influence over it. I see the best execution that I see on appraisals is when the listing agent will meet the appraiser at the house with comps in their hand.
Yeah,
and say,
that's the best way I've heard to actually manipulate anything. And you're not going to change their opinion because.
No, you're not going to change their opinion, but you're going to give them the data that you use to establish the value.
As long as it's legitimate and real and everything else,
it's legitimate.
It can have an impact, but there's a trick to the trade to how to make that happen at the right time and everything else.
Absolutely.
But I think people have this perception that they're going to be able to argue data and data's data. You have to be legitimate on it. If things aren't above board, you shouldn't be doing them no matter which side of the transaction you're on, because it's going to come back.
You're not going to change the data.
No, and the system doesn't work if we're not honest and fair and real with each other. Something breaks, and that's a short-term thing. So I've got Seth told me my video went out. I think I'm still up on mine, but it's certainly, I know it varied for one of the participants. So we'll go for a minute. If you guys continue to have problems, feel free to poke in on the side. Let us know. Also, we are taping this, and so we'll put it out on our Facebook page. Candy will have access to it as well. So if you need to get a recap and just kind of go over it, if you missed a segment and you want to hit, then you'll have access to that later if your internet connection is a little spotty. 3 things that'll be a little bit more fun. And then after we do kind of get done, Candy, I want to make sure that do you have access to the chat box on your screen?
I do.
Okay. I just want to make sure before you leave that maybe you can put your phone number, main phone number, and spell your name accurately in there and your company name, just so that if folks are even on the thread with us, that they can have it promptly in front of them.
Great.
You may have questions that come up today, and I know how great you are. So 3 fun pieces to kind of close out today. So you have seen, done, and been around it all when it comes to real estate and investing. And I really value your opinion tremendously. But I want to know if you can throw a couple nuggets to our participants today, or to those that may catch this later. What advice would you give an investor? Now, you're coming from a lender perspective, but you've seen a lot, and so you can speak to everything you've experienced. What are the 3 most important things you would share if somebody told you they just wanted to get in real estate?
Well, first of all, is they need to make sure that they maximize their credit scores. So at 760 and greater credit scores is when you're going to get the best interest rate. Every 20 points your score drops below 760, your interest rate will be impacted. If you're getting mortgage insurance, it will also be impacted at those same intervals for mortgage insurance. So I tell people, make sure you keep your credit card balances as low as possible. Even if you have no bad credit, if your credit cards are charged to the maximum, it will drive your scores down because your available credit is limited. So maximize your credit scores, pay your credit cards down as low as you can. And the obvious, make sure you don't have anything go to collection. So one of the worst things that can happen to someone is they have a $20 medical collection that hits their credit report right before they're ready to buy. And that medical collection will drive your credit scores down so low that the algorithm that calculates credit scores doesn't differentiate between a $20 collection and a $20,000 collection. It's just a collection. So just make sure you're keeping your credit score maximized as much as you can, so you can optimize your interest rate. The other thing is we're going to need 2 months worth of bank statements showing you have your funds for closing. If you sell a car, if you get any type of distribution, any money you deposit into that account, we will have to source where that money came from. So it's very important that you track any money. If you're going to sell a car that you don't have a title to, do that, put it in the bank and wait 2 months before you buy. If it's in your bank statements for 2 months, we're not going to have to track anything. So tracking money is one of the things that makes people the craziest about the mortgage business, because we're looking at your bank statements and nobody likes that.
Personal, right? Absolutely. You're going to divulge everything. So you need to treat your personal finances like a business. Keep records. Do things right. Don't start shuffling things behind the scenes, because I'm sure you've got a lot of clients that come to you and go, well, I want this loan, but my business is cash only, and you're like, I
we can't help you.
And it's not that we don't love you, but you can't.
Absolutely.
That's not how everything works. If if you're not above board and you have records, then nobody else believes that they're going to want to do business with you. So
absolutely.
They could do business with cash, but they're not going to get a loan.
Right. Absolutely. So the money piece is very important, along with the credit scores. Those are probably the two biggest things that are going to affect your cash flow, your interest rate, and your grief throughout the process of the mortgage. So we try to limit that as much as possible, but there's a certain degree of processes that go along. And to just remember, it's a process. One thing happens after another.
Yeah, and we've still got to come back to your best piece, your third piece. But I had a client come in this morning, and it was their first time buying a house, and they said, what about this? And I said, all I want you to do is, he was using Dropbox. I said, put every one of those documents you have ever had in one Dropbox, wherever your storage place is. You will be so happy you have those when the years come up, because you're not digging for them. You will eternally need those as you buy one house, sell another house, qualify or something. Man, having that stuff dialed in just year to year, tax returns, just in one space, will save you so much frustration. Right.
Absolutely.
So what's number 3? What's the best thing you got for them?
Oh, I don't know. I was thinking about number 3. We were talking about not being able to have gifts. And that's so important, because husband and wife teams, we can't use the wife's money if she's not on the loan. Say her credit score's not as good, but she's got the cash. You can't use that money. So make sure all those transfers are done 60 days prior to you purchasing the property, so that we don't have to paper trail any of that. We do drop spouses off, be husband or wives, all the time, because one's credit score is not as great as the other. And really try to make sure that we maximize the borrower's qualifying so they can get the best interest rate. So I think that's very important as well. And then to remember that you're getting one of my favorite things about investment properties, and this isn't for everybody, but if you can cash flow and do a 15-year mortgage, there's nothing greater than a 15-year investment property. The acceleration of the equity position is unbelievable on a 15-year loan, and someone else is making that mortgage payment.
Yeah.
So that is my favorite thing about investment properties, is if you can make it cash flow on a 15-year.
Even if you get the 30 at a higher rate slightly, but you pay it on that 15-year schedule, the difference in your long term is so dramatic. And again, you've got to be focused down the runway. You can't look right below, but it's so dramatic. It's incredible. We started doing, I'm not sure if I shared this with you or not, but we have enough data, because we've done this so long, that when customers give us basically the laundry list of questions you're asking, what's the principal, interest, taxes, insurance, all your monthly, blah, blah. We, because we manage their property, have their income and expenses. And we can plug those into a spreadsheet we have and actually come out with what their true return on investment, so the initial investment is, but we can
Right.
also project based on all of our experience what it should be. And so if there's an anomaly, we can go, okay, well, did we need a new roof this year? Or if it's even better, we can go, did you have no expenses? And so therefore that's why. But we're almost able to predict within about 2% now a return on investment for a property that we've never seen based on age of it and expectations in the market and things like that, including vacancy and all that other good stuff. And I got to tell you, most folks are coming out between 12 and 18% return on initial investment. It's really kind of incredible. We had somebody come up with this week we did one that the house had been owned by the family for, let's say, 70 years, maybe even more than that. And so, well, they paid like $13,000 for the house or something ridiculous back then.
Right.
So their return on investment was exponential, but we said, okay, then what's the cash on cash? So based upon the value, if you had that in cash and you reinvested it somewhere else, what are you making in income every year? And it came out to be 5% pre-tax. So if they were to invest in a bond or something, municipal bond or whatever, well, they're not getting anywhere near that. And that investment, it's completely paid off. It's insured. There's no risk. And so, they may want to get 18% on their money, but that requires risk. Where, boy, if you're retired and you're making 5% at zero risk, not too bad. But it's again, time is the enemy. It's not the money. We can invest and make all we want, but that 15 years makes all the difference in the world when you start extrapolating it out and wanting to buy your second or third or fourth or fifth property. Because the faster that's paid off, now I can do something in the future. Where if I'm on a 30-year note, I never accelerate those payments. Well, I'm going to be retired in 30 years. So it works. But boy, 15 is the way to go.
Absolutely.
I think it's amazing. I completely agree with you.
And I tell people this all the time. So say you're a little negative cash flow each month. If you do a 15-year, you're not negative when you look at the principal reduction.
Boy, I wish we should have planned this better. I've got this on my board upstairs.
It's crazy. It's crazy. So say you're 200 negative, but have 800 going to principal, you're not really negative. And so it's sort of a forced savings. You're accelerating your retirement position by coming out of pocket a couple of hundred to get that 800 a month principal reduction on that investment property. Because typically people who want to invest are people who are looking forward to retirement. They want to retire in 15 years. They want to retire in 20 years, whatever. They're at the highest income level that they're ever going to be at right now. So pay that couple of extra hundred a month to the principal to get that 800 principal reduction every month, because it just accelerates your retirement that much quicker.
So a lot of our clients come back on an annual basis if they have expenses or they're tight on the numbers, and they go, I lost $3,000 last year. We've got to sell this thing. I can't do. And we go, okay, wait, just hold on. Let's look at the math. And if the right decision is to sell, we sell, no questions. But let's let the math tell us. Let's not feel about it. And there's 4 pieces of that equation. Cash flow is only one of those. You got cash flow. You got paying down the principal, so equity that way. You've got appreciation. And then you've got tax benefits in 2 ways, whether it's a loss or whether it's depreciation on the property. That makes your return on investment, not cash. And so when we take all those together, I have one client, she married very well, and she has this condo which she lived in on South First, and she's taking a hit on it every month. I mean, maybe $350, $400. And so I want to sell. Okay, great. But let's look at the numbers. So we looked at the numbers. That stinking thing has gone up in value so much. She's paying the mortgage down at like $500 a month. So for that $400, she's getting $1,400 in return. Now, people don't feel good about that. But think about this. You're going to put $400 in your 401. And who controls that? Wall Street? I'm not feeling good about that.
Yeah, me neither. That's how I got into real estate to begin with.
Is it? Tell us that real quick.
Oh, no, I just was like, those dirty dogs in Wall Street, I don't want to give them my money. I don't trust them. I want my investment. I can drive by, I can touch it, I can feel it, I can see it. I see my future. I can see it. And so it's a driver to purchase real estate. it's personal, you know.
So I'll tell a real quick story that's funny that was passed along to me. So I have a friend who's a $10 million friend. He was hanging out with a $100 million friend. He was telling him a story about a $100 million friend who got invited to hang out with billionaires. So he's just happy to be there, right? This $100 million guy is like gleeful, and he got invited to Switzerland, and they're hanging out. They end up in Monaco, and they're hanging out at a back room in the casino. And he's just giddy because he's, everybody else there's such big cheese, and he's a big cheese, but to them he's not. And he said somebody made a joke, something about the stock market, and the whole room started chuckling. And he didn't say anything, but he went to his friend later and he said, I'm so happy to be here. I can't thank you enough. He goes, but I don't understand what happened. He goes, oh, the stock market is not something you do. It's something you do to people. So if I have a company that is producing really good rates of return, I'll never sell it. But when I think it's flatlined or it starts declining because I'm making 8% of my money and not 50% of my money, well, you go public with it. And then all the people like us that don't have the option to make 50% on our money get stuck buying the leftovers of what those guys, after fees and after management, after everything else, leave for us to have. So the joke was, yeah, if that's where you are, that's not where the billionaires are, because they have other options. But it was a real kind of blunt story about the reality of Wall Street. And I have stocks, I have 401 and all that too, but
yeah, I mean, I have 401.
But we got to diversify. We've got to trust ourselves
Right.
to do some of these things
That's
that are
right.
no-brainers, instead of just giving our money to people we'll never see and just go, please, I hope. I don't know. It's scary to me. I know it does
Right.
well over time, and I believe Warren Buffett's a genius, but there's not a lot of Warren Buffetts out there.
No.
If you
And it's never good to have all your eggs in one basket.
agree. So this has been outstanding. We've got a couple minutes left. I think we've got one question on here that we can at least address. And then Candy, do you want to take just a moment at this second before you answer that to put your name and phone number and everything on the chat box? So if anybody just wants to consult with you, they can. And then the question was about
Sure.
the collections and things like that. And I think I know the answer, but I'd rather make sure we're right and collaborate on it. While you're doing that, next webinar is April 4th. And it's going to be the same time, and it's going to be about the Texas Property Code and rekeys and things like that. So if you are a landlord in the state of Texas, there are state laws that are applicable to you. I can tell you that almost no one, if you're not a really good property manager, knows what those laws are. Most of the time things go well, but your liability is exposed. Your liability is increased, and there's just no point. So there's some real basic things we need to do, some commonly missed things, and then also what's coming with the upcoming legislation, because it changes every session. New laws get passed. And so next time we get together on April 4th, it'll be 11:30 as well, and Mr. Hernandez from Rekey will be with us, and they're kind of experts on the Texas Property Code, because they'll check properties for locks. Believe it or not, your locks, they have to be the right height, not just installed. They have to be the right kind of locks and all this. And modern technology is out here. The legislature is back here. So it takes a minute for all that to catch up. And just because you think it's safe doesn't mean you're legally in compliance. So we'll cover that next time. So thanks for putting your info up, Candy.
You're welcome. Thank you for letting me join in.
Question was about collections, and I think we're good there, unless somebody else has one that they want to pop up. The guy was saying, if you make the payments, do you go to collections? And I think the answer is, as long as you're making payments, they wouldn't send you to collections. So it's a non-issue.
Correct.
It's really when you just
Correct.
you stop returning their calls and they can't find you, that becomes a problem.
And what we see a lot of times too is people don't realize they have a $20 collection with the medical. I mean, they just, maybe they moved last year and the address didn't catch up. That's the get you that really hurts people. Like, where'd that $20 come from? I always pay it. So that happens frequently.
Who that's got 20,000 is going to ignore 20 unless they're a little angry or something.
I mean, nobody is.
Yeah.
No, right. Absolutely. And people that are going to buy investment properties, they're watching this every day. But I see these medicals are the worst. They're the worst that pop up out of nowhere.
Well, and those companies built through so many different parties, and the doctors in the office, and then the anesthesiologist and the nurse. And so those bills can go anywhere and you don't even know they exist. So it's part of life, I guess, but you got to stay on top of it. So what do you recommend for people that, obviously you're capable of seeing full credit reports, but what do you recommend for a consumer that just wants to stay on top of their credit?
I mean, they can look at Credit Karma. Just keep in mind, Credit Karma is a consumer credit report, not a mortgage report.
Mhm.
So whatever you're scoring on consumer credit reports is going to be higher than what we see,
Right.
because the algorithm is different on a mortgage report.
Apples, oranges. Just because it says it at TransUnion doesn't mean Experian or Equifax believes that same number.
Right. And don't dispute your credit unless it's really a real dispute. And typically disputes will have to be removed when
Don't
we
make
do
a fight
loans.
if you're not being honest about it.
Well, we have a lot of people who've frozen their Experian, and that's a real problem because they have to go unfreeze it, which it's a lot easier to freeze it than it is to unfreeze it. So
Yeah, and Seth was asking, and I think you're right, Seth. As long as you're paying and they get in touch with you and you stay in touch with them, I think there is some leeway for a lot of that when it comes to medical. Corporations are
right.
not quite as generous. But the
Yeah,
key is
exactly.
you just don't want them to send you away, because at that
Yeah,
point they're not
that's right.
expecting to collect, and they're just, if they get a penny from you, they're happy and you're in trouble. So don't
Just watch your mail. I mean, that's the main thing. The problem with today's world is so many people, everything they do bill pay online. They don't even open half their mail.
I know.
And half the time you get a collection notice, it looks like junk mail. So it's a problem. I mean, it's a real problem.
Maybe they should put those in a pink envelope or something special.
Or something. Yes. Wouldn't that be great?
Yeah. It would actually help. So, well,
it would be helpful. Or not be able to report them at all. That's really what should happen. Is medical shouldn't be able to be reported.
Yeah, or something. Maybe there's I don't know what there is, but it would be nice if there was a better way to get a hold of people as much as we move nowadays around the nation. So,
right.
Candy, just I know you know this, but just to say it out loud, I think the world of you. I just think you're the best thing ever, and I trust you immensely when it comes to business, and I appreciate your decades of professionalism. And I appreciate you joining us today. And I'm always here for you. You know where to find.
Yeah.
So,
and I'm here if you need anything. I'm happy to help any way I can.
Awesome. And so you guys have our contact information. I really appreciate you guys joining in. Hopefully we'll have a recap of this if you missed any of it, that we can push it out on our Facebook page and website and things like that. If we can help you at 1836 Realty and Property Management, reach out to us. We're here for you. And even if it's a question about something, just to get a referral. Same with Candy, she knows people. We've been in this a long time. So it doesn't have to be just about money. It can be about, I need advice on this, because building those relationships builds trust. And that's how you survive long-term and succeed. It's about the community. It's not just about getting paid today.
Sure.
That doesn't give you a good feeling in your heart. And, having a family around you and of professionals gives you that good feeling. So,
absolutely.
Really appreciate you guys, and contact either one of us if we can help you, and we'll see you next month.
Okay. Thank you so much. Y'all have a good one.